Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
Today we're breaking down the seismic shift in the VMware franchise following its massive $69 billion acquisition by Broadcom.
On the surface, it looks like a classic private equity playbook. But the real question for us as long-term investors is this. Has Broadcom's ruthless stewardship enhanced or utterly destroyed the enduring quality of this fortress? That's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, really.
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model and all that friction.
Okay, let's unpack this. For decades, VMware was just the foundation of enterprise IT. It was this quiet, mission-critical thing that powered everything.
Everything, from banking to government.
And then Broadcom steps in, drops this colossal $69 billion, and just poof, the standalone company is gone.
It's more than an acquisition. It was an aggressive intervention. The stock VMW, it just doesn't exist anymore. So for you, the question completely changes. It's not, can I own the stock?
Right.
It's what's left of the franchise. Has this new, let's be honest, ruthless command enhanced the fortress? Or have they just started pulling the bricks out one by one?
And they wasted, what, 0 time showing everyone what that new command looks like?
Oh, none. It was immediate. They came in and just tore up the playbook.
A seismic shift is what people are calling it.
Seismic is exactly the right word. First, they killed perpetual licenses, that classic CapEx model where you buy the software once. Gone.
And crucially, they also killed the free ESXi hypervisor.
Yes, which was the main on-ramp. It's how a whole generation of IT pros and small businesses got into the ecosystem.
So now everything is mandatory.
Mandatory bundled subscriptions,
Yeah.
VCF and VVF.
Huh.
It's a forced march from flexible CapEx to a really inflexible OpEx model. And it happened, basically overnight.
Okay, that pivot leads right to the customer friction. You mentioned the 2 main bundles. Can you just quickly define what they're forcing people into?
Yeah, the goal was simplification, or at least that was the story. They took something like 160 different products and crammed them into 2 main bundles.
Okay.
The flagship is VMware Cloud Foundation, VCF. Think of that as the all-you-can-eat private cloud stack. Compute, storage, networking, security, the works.
And the other one?
The other is vSphere Foundation, VVF. That's more mid-level, mainly for your core compute virtualization, some basic management.
So on paper, that sounds efficient. Fewer products, higher margins. But the feedback from customers has been, well, brutal. Where's the most pain coming from?
It's the new terms.
Yeah.
The brutal enforced complexity of licensing, especially if you weren't already a huge enterprise.
So it's not just that you have to buy the networking module you don't need.
No, it's worse than that. It's the minimums. We're hearing about this 72 CPU core minimum for renewals.
Wait, hold on. So if I'm a small shop and I only need, say, 32 cores, I still have to pay for 72.
We are paying for 72, exactly.
Yeah.
And it's widely seen as a blatant dismissal of the entire SMB market. They're intentionally firing their smaller customers to focus on the big fish. It's harsh.
That feels so short-sighted. You're
Yeah.
actively alienating your future growth. But okay, let's play devil's advocate. The cloud reset argument. Why might this timing actually be perfect for Broadcom?
Well, the bull case is that the hybrid cloud is here to stay. Enterprises are not, I repeat, not moving 100% to public cloud.
Right.
93%, the numbers show, maintain a mix. For security, for compliance, and now, a huge one, for running generative AI models on-prem. We're even seeing workloads come back from AWS and Azure.
Repatriation.
Exactly. And since VMware is basically the Windows of the private cloud,
Yeah.
Broadcom is just aggressively monetizing a monopoly that isn't going anywhere.
So the demand is solid, but the monetization is hostile. Does that lead to the big long-term risk? Is Broadcom just harvesting a shrinking ice cube here?
That is the core bearish argument.
Yeah.
The whole industry is slowly but surely shifting away from virtual machines, VMs, to containers, Kubernetes.
The more modern architecture.
It's modern, lightweight, scalable. If that trend really picks up speed, then yeah, VMware could become the next mainframe. incredibly profitable for a while because of the lock-in, but ultimately a shrinking business.
Which brings us to the big question. Why haven't all these furious customers just left? What is keeping them chained to VMware? Let's talk about the economic moat.
It all comes down to high switching costs. It's one of the strongest moats in tech.
Mhm.
And the lock-in, it's systemic.
It's not just the hypervisor.
Oh, not at all. It's your backup systems, it's your security policies like NSX microsegmentation, which is deeply integrated. It's all your automation scripts. Ripping it out means you have to basically re-architect your entire IT department.
And there's another layer to that, which is the people lock-in, the human capital.
Absolutely. Think
Yeah.
about it. An entire generation of IT admins and cloud architects, they built their careers on getting VMware certified, the VCPs.
It's a huge career risk to propose a migration.
A massive personal risk. The path of least resistance is to just stick with what you know. Stick with the platform you're an expert in.
And now we have the ultimate proof of this moat. I mean, this is where the story gets wild. Broadcom's price hikes.
The numbers are genuinely astonishing. We're seeing renewal quotes jump 800%, 1,500%.
That sounds almost fake. Is that just cherry-picked data from a few small, angry customers?
You did think so. Broadcom's defense is, hey, you're comparing one small old license to a new all-inclusive bundle. But the pain is real even for the giants. Look at AT&T.
They're actually suing.
They're suing Broadcom. They allege they got a renewal quote that was a 1,050% increase. You cannot attempt that kind of price hike unless you have an ironclad moat.
Okay, so you have this massive outrage, you have lawsuits. But what were the actual results? Did everyone leave?
The moat held. It's incredible. They successfully shifted over 90% of their 10,000 largest customers to the new model. The lock-in was stronger than the outrage. The cash flow proves it.
So Broadcom is making this brutal but very profitable great trade.
That's a perfect way to put it. They are systematically liquidating the soft moat, the brand, the goodwill. Customers feel like hostages, but they're trading that for a harder, deeper technical lock-in. By forcing everyone into the full VCF stack, they're making it even harder to leave 3 years from now at the next renewal. They are digging the moat deeper.
It's like they're weaponizing the switching costs. Which brings us to the competitors. If we use the Charlie Munger model to invert, always invert, if you wanted to kill VMware, what would you do?
You would do exactly what Broadcom is doing. You'd create a C-suite mandate to find an alternative. You'd kill your partner ecosystem, which they did, culling 4,000 partners.
You'd destroy the talent pipeline.
Like killing free ESXi? Yes. The next generation of engineers has to learn on other platforms now. And then you'd shock your best customers with 10x price hikes. They're basically writing the playbook for their own long-term decay.
So who are the hyenas at the gate picking up the pieces?
Two main players, two different strategies. First, you've got Nutanix. They're the simple migration path.
They're being very aggressive.
Unbelievably aggressive. Specific Broadcom to Nutanix promotions. Their tech is seen as simple, user-friendly. They are laser-focused on the angry, cost-sensitive customer who just wants out.
And competitor number 2, Red Hat, is playing a longer game.
Exactly. Red Hat, which is owned by IBM, that's the technological leapfrog path. They're not just selling a cheaper hypervisor, they're selling modernization. Their whole pitch is about unifying your old VMs and your new containers on one platform.
So their argument is, don't just swap one legacy system for another.
Right. They're telling the CIO, leapfrog into the future now. Move to the platform that handles the next decade of development.
And there's a hidden risk here that I think the market is missing, the brain drain. Broadcom has laid off thousands of loyal, longtime VMware engineers.
This is a huge, underappreciated gift to the competition. These are the people who literally built the moat. They know all the secrets, all the weaknesses, and now they're free agents.
And they're going to work for Nutanix and Red Hat.
Of course they are. The very architects of the prison are now available for hire to help the inmates build escape ramps.
Okay, let's pivot to the financials. All of this comes from the top, the Hock Doctrine. What is the CEO's philosophy here?
It's a public company run like a private equity firm. The doctrine is simple. You acquire dominant franchises, he calls them toll roads, and then you apply ruthless efficiency.
Which means /R&D.
/R&D on anything that's not core. Eliminate sales overlap, focus only on your top, say, 20% of customers, and just generate maximum predictable free cash flow. There's no room for sentimentality. It's a cash machine.
And his personal incentives tell the whole story. His pay package is aligned with one very specific metric.
AI revenue, specifically from the semiconductor side of the business. His compensation is almost all tied to their custom AI chips and networking gear.
So VMware's role is?
It's the funding engine. It's the cash cow that pays down the acquisition debt, which is already down from 3.5 to 2.1 times net debt to EBITDA, and funds the R&D for the high-growth AI chip business.
And the proof is in the numbers. I mean, the profitability is undeniable.
It's a machine. The combined company is guiding to adjusted EBITDA margins in the 65 to 68% range. The VMware software unit alone has supposedly gone from 29% margins to a staggering 70%.
So with that kind of quality, how do you even find a margin of safety? The valuation is rich, trading at 54 to 67 times non-GAAP earnings.
You can't. You can't wait for it to be statistically cheap. The market won't give you that. The only real margin of safety would come from a narrative-driven panic.
A customer cliff narrative.
Exactly. You'd need a couple of huge name brand companies, a global bank, a big telco to very publicly announce they're leaving VMware entirely. That panic would be your entry point, assuming the core cash generation is still there.
Okay, let's synthesize this. Level 1 versus level 2 thinking.
Level 1 thinking is easy. The deal's a home run. Hock jacked up prices. 90% of the big customers paid. The cash is gushing.
And level 2?
Level 2 looks at the shelfware clue. Hock himself admitted that customers bought VCF, but they haven't actually deployed it yet.
What does that tell you? That they bought it but aren't using it?
It tells you the revenue is a coerced payment. It's not loyalty. The customers are just buying themselves a 3-year window to plan their escape. Broadcom has made the cost of staying so high that the cost of leaving finally looks manageable, even necessary. That shelfware is a 3-year countdown clock.
So the key catalyst for Broadcom, say over the next 3 to 5 years, is solving that obsolescence risk we talked about earlier.
100%. They have to make VCF the default, the only on-prem platform for AI workloads. If they can convince big companies that VCF is the most secure place to run private AI models, they solve the Kubernetes threat and perfectly align the software business with Hock's own AI incentives. It's their only long-term play.
They've certainly put all their chips on that financial lock-in, which leads us to our final provocative thought for you to think about.
Broadcom has made a profound mistake. They have confused customer lock-in with customer loyalty. And by killing the free on-ramps and laying off the veterans, they've destroyed the talent pipeline. So what happens in 10 or 20 years when today's VMware certified IT pros retire?
And the only new engineers coming up are skilled on the free competitor platform.
Exactly. The ones Broadcom just handed to their rivals. That's the cultural time bomb that's still ticking, and the market doesn't see it yet.